Well, good afternoon, everybody. My name is Mark Brownridge. I am Strategic Relations Director at Blackfinch Investments. It's great to see so many of you here, so thank you very much for joining us today. Look, we know this is a super busy time of year for financial advisors. We know that tax year end is hoving into view, a really great pace now, and that you're out there talking to clients about investment recommendations and tax planning scenarios. So that's exactly why we wanted to put on a webinar about EIS and VCT investments, because we think these are investments that tick both of those two boxes. So there are investments very much first and foremost, but of course they have tax advantages attaching to them at the same time. So great time to be talking to clients about them, and it's a really great landscape at the moment to be talking about EIS and VCT investments. We'll explore that as we go through the webinar. And we'll also give you 5 reasons or 5 key takeaways to talk to clients about EIS and VCT and why now is a really good time to invest, both from an investment viewpoint and from the tax planning viewpoint. So that's like on the next 45 minutes or so. We'll go through EIS and VCT investments and the current landscape. Obviously, there's important information to get over to you first and foremost. So Blackfinch are authorised and regulated by the FCA, the Financial Conduct Authority, and any information taken in this presentation shouldn't be taken as legal, taxation, or financial advice. We'll be talking about EIS and VCT, surprise, surprise. So as the FCA tells us, these are high-risk, illiquid investments. So obviously these are 5 FCA key risks in relation to that. Learning objectives are all important learning objectives. So there are 3 of them as per usual. So we're going to describe the venture capital landscape, what's happening at the moment, what's gone on last year, what's going to happen in the year ahead, and how EIS investments and VCT investments are helping entrepreneurs, how they're helping the economy, and also importantly, how they're helping investors. We'll look at the schemes themselves, so the tax reliefs, do a bit of a 101 on what they are and how they apply. And then we'll put that into different client scenarios so you can try and identify different types of clients who these type of investments might be applicable to. And then we talked about it already, but we'll look at the risks, we'll look at the types of risks, we'll look at how we can mitigate those risks. And then at the end, as I say, we'll look at those 5 key takeaways on why now is a really good time to be looking ahead for 2024 and looking at these type of investments. As I say, if you have any questions as we go through, please do use the chat function down the bottom there. Hopefully you're all veteran Zoom users by now, so please do pop your questions on there. We'll either pick them up as we go through or we'll pick them up at the end. Okay, so let's get into the bare bones of it all. So why are SMEs important? So we're obviously talking about EIS and VCT investments, and they invest in early stage small, medium enterprises, or SMEs as they're otherwise known. But why are they important, and why do we want to invest in these type of businesses? Well, they're important because there are 5.5 million small businesses in the UK. They make up 99.2% of the total business population, and they account for 3/5 of the employment in the UK, which is around 16.7 million people, and that's about half of the turnover in the UK as well, which again is about £2.4 trillion. So whilst we talk a lot about the FTSE 100 and the blue chip companies and those big companies, actually it's the SMEs, is those earlier stage companies that drive most of the growth in the UK. That's why it's so important we have more of them, and more importantly, why we scale up some of those small companies to try and become bigger companies as well. So that's why they're so important. I work for an SME, good chance you work for an SME or founded an SME. Most of us in the UK do actually work for an SME. Looking across Europe, McKinsey did this study a few years ago now, but it's still relevant. So it looked at the top 1,000 European tech startups in Europe from 2000 across 33 different countries in the European Union. So you can see here, out of the top 1,000 companies, 319 were founded in the UK. The UK, as it says there, is a real innovation hub of Europe. It's a startup and scale up capital of Europe. We start up lots of companies. We're one of the biggest in Europe at starting them up, but we're also, as it says here, one of the best at scaling those companies up. On top of this, we're home to 10% of the world's fintech unicorns. A unicorn, member, is a company that's valued at more than £1 billion. And the UK has produced 38% of the total European unicorn value and produced around 40,000 jobs as a result. So we're great at unicorns. Of the last 85 unicorns, we've been responsible for 44 of them in the UK. And there's some household names out there that you might well know, I'm sure, in terms of Atom Bank, for example, Starling Bank, SumUp, the contactless payment connect system. Other companies that aren't fintechs I can think of would be Gusto, the home delivery box, Gymshark, again, the leisurewear that has been founded in the UK. And probably the well-known one most of all is probably Brewdog with the craft beer. So UK is a real innovation hub for startups and scale-ups. The government's recognised this, so we had the Mansion House Compact late last year that is looking at how do we get more pension schemes to invest in venture capital and growth equity. At the moment, as it says here, only 0.5% of UK DC pension assets are invested in venture capital and growth equity. So how can we drive that? How can we push that forward? How can we get more pension assets into the sector? Because as Jeremy Hunt says there in the first bullet point, by doing so, we could add £1,000 a year for the typical earner over the course of their career by investing in these early promising companies. So we're looking to get about £50 billion under the compact into more venture capital companies, into more companies that are driven at an earlier stage. So very much the focus of government to keep in this area. And of course, we already have some schemes in place in terms of tax advantage venture capital schemes in the UK. We've got the Seed Enterprise Investment Scheme, Enterprise Investment Scheme, Venture Capital Trusts, and Social Investment Tax Relief. What's the point of the schemes? Well, essentially, we're trying to facilitate the smooth flow of capital from early stage companies into, from private investors into early stage companies who otherwise struggle to get investment from other sources. Banks don't want to lend to them. Building societies don't want to lend to them. It's just too early stage for those type of institutions. So that's where equity investment plays a really key part. Another point to make there is a lot of smaller companies can't take on debt. They just don't have the revenues to be able to service the debt. So equity investment really, really is their only option. And so if they don't have a source of equity investment, they're going to struggle. As I always say, EIS shouldn't stand for Enterprise Investment Scheme. It should stand for economy, investors, and start and scale ups, because they're the three key stakeholders that schemes and VCT schemes all benefit the most. So the economy, in terms of the significant contribution that EIS makes to the economy. So we know that for every pound that goes into EIS, that makes £3 for the government in terms of revenue and tax that they get back from the companies they're supporting. So that's super important, particularly, I would suggest, at this time where we're not doing particularly economically well in the UK. The I for investors, again, really important. Obviously, there's the tax relief applying for investors, but this is an opportunity for investors to get in at those companies at the very first floor. If you imagine the Empire State Building going from first floor to top floor, this is an opportunity to get on the first floor and go on that journey all the way to the top floor. And for start and scale ups, yeah, it's a bit of a no-brainer here. They need the money. They're looking for funding. Again, it's a pretty dire landscape out there for many companies at the moment who are trying to find funding. EIS VCT is really the only option for many of them. Again, we have a kind of a confirmation from the UK government that the EIS and VCT are going to be around for a long time to come. So you may have been aware of the kind of the sunset clause that's been hanging over the schemes for the last couple of years. So the sunset clause is something introduced by the EU back in 2015. And it basically said, look, we like the schemes, we'd like them to continue. They're doing exactly what we need to do, filling that kind of gap in the market where funding doesn't currently exist. We're only going to let them be allowed for another 10 years, and that takes us to 2025. So in those 10 years, you might be able to remember, but we've had a couple of issues, one being Brexit, where obviously we've come out of the EU now, so we get the schemes back. We have much more oversight on the schemes and how they're run and how they're operated. So the government has reconfirmed to say, yeah, again, we like the schemes. We've done a study into those schemes. We'll have a look at that in a second. But the schemes are going to be here for the next 10 years at least. So that takes us to 2035. So for us as investors, VC investors, that's really, really important. We know the scheme's going to be here. We know we can keep investing. And for you guys and girls as investors and IFAs, again, it gives you that confidence that schemes are going to be around for the next 10 years in their current format, all the tax release as they have been. And we're only hoping that the schemes are going to be improved, if anything, if the Labour government comes in. As I said, HMRC did a study in conjunction with Kantar into the schemes and evaluation in 2022, and it found out lots of different things, but these are the main 4 key things that study came out with. So the first one, top left, the tax relief incentives, in particular the income tax relief, were found to be a considerable motivator to investment involvement in schemes. Probably comes as no surprise to you, obviously 30% income tax for EIS and VCT, and we know income tax revenues are up by about 70%. Since 2010, so a lot more people paying a lot more tax. The main driver for the schemes is probably the income tax relief. Bottom left there, the venture capital schemes are successful in attracting high investment from high net worth individuals. So that's great. Obviously, we're seeing money come in. And advisors who recommended them to their clients saw multiple benefits. So obviously the tax relief, we talked about the investment proposition there. Advisors, financial advisors who are recommending these to their clients saw lots of different benefits, which is all for the good. Top right there, going on to the company side of things. So the majority invested companies saw that EIS or VCT was essential or very important in terms of raising finance, i.e. without these schemes, they wouldn't have been able to get the funding that they needed. So it's super important for those companies. And then bottom right, EIS found to have a positive impact on businesses across a range of sectors in the UK economy. So it's not just a particular sector, it's across a range of different sectors. And that each of turnover, assets, and employment are statistically significant and positive relationship in all sectors. So EIS, VCT saw increases in turnover, assets, tax, employment in all the companies they invested into. Probably the most important point there, the valuation did not identify any better alternatives to the venture capital scheme. So there are potential alternatives. Obviously, you've seen the British Business Bank have lots of investment programs. There's lots of debt options out there. But actually, government's saying here is these schemes do exactly what we want them to do. They do exactly what they say on the tin. They provide funding to hit the gap at that very earliest stage of funding. And that's why it's so important. Just a quick recap on the tax reliefs. I've talked about them a couple of times, so probably best just to do a bit of a 101 on what they are and how they work. So starting with VCT, obviously we've got the 30% income tax relief. It's a minimum period of holding period there of 5 years. The big one with VCT is the tax-free dividends. Obviously, it will pay out dividends, and we'll talk about dividends later on as we go through, but they are tax-free, so really, really important. Any growth within the VCT itself is free of capital gains tax. Obviously, capital gains tax rates are changing, so that's going to be an important one. And the maximum permitted investment is £200,000 per annum. EIS has 5 tax reliefs. It's one of the most tax-advantaged investments in the world. Again, we've got the 30% income tax relief, but it's a 3-year holding period for this one. And don't forget, of course, really important at this time of year, if you can get fully invested this side of the tax year, you can carry back to a previous tax year. We've still got the CGT-free growth. Another important one with EIS is the loss relief. You get share loss relief if things do all go wrong, if the companies go bust. You can still get some share loss relief back, so that's an important one. Another important one is the CGT deferral. So if you've got gains from elsewhere, you can just defer those into an EIS investment. And that defers the gain, doesn't extinguish it, but does defer it. And then finally, we've got the inheritance tax relief as well. So if you're holding shares for 2 years, that will qualify under business relief for inheritance tax relief. So you get 40% relief there. So maximum investment of £1 million on this one. It can be £2 million if you're knowledge intensive, but we won't focus too much on that. And of course, you need to be a taxpayer and over 18 years old. I just wanted to run you through the investment life cycle of a company as well, just to understand where we're investing as an EIS portfolio and as a VCT portfolio, but just a general life cycle of a company as it starts on the bottom left here as a real startup, back of a fag packet idea of a company really, all the way up over to the right here. And this is kind of a classic hockey stick journey of a company, but all the way up to the right here where you're going on to a listing or maybe getting institutional investment. So starting bottom left, this is a real, just an idea of a product at the moment, or a SaaS proposition, or an innovation that you have. So what we have is a minimum viable product. So this is a product that we thought of, we've got some ideas behind it, but at the moment it's at kind of its very earliest stages. We think it's going to be good, but we haven't done any kind of market analysis or testing. It's really still in the thinking in the early stages at that point. So the only people who are going to invest in a company at this point are probably going to be friends and family, people who invest and know the founder and entrepreneur and really trust in them, or it's going to be angel investors who are obviously really sophisticated investors. They know this end of the market really, really well, and they're prepared and have the risk appetite to invest at this point. Moving on up our curve, we get to the point where we're at what we call a product market fit. So now we have a product, it's in the market, but we also importantly have a market, i.e. we have someone to sell to. Because without someone to sell to, we don't really have anything there. So we can now bring those two things together. And that means we're starting on that, as it says there, that's the cusp of that scale-up journey. So we're starting to see some revenues coming into the business. We're starting to get a client base. Probably got 4 or 5 key clients at this point. Everything's starting to work. Everything's starting to look like it could take off. And you know what? Yeah, this could be something. A good example of product market fit, by the way, might be Saga. So we all know that Saga, its market is really the over 65s, the over 60, 65s, that kind of age range. And they make products that hit that market. So they have holidays, they have insurance, but they know their market and they make products that fit that market very nicely. This is where our Ventures EIS will start to make its investments. So we'll put some early stage money into the companies here. and we'll follow them as we go on that hockey stick journey up to the next stage. And that next stage is really the growth journey, as it says there. So our companies are doing really well now. We're starting to see really established revenues. We might be pushing into profit territory. Our customer base is building. So rather than having 4 or 5 key customers, we might have 20, 30. We're really starting to build things out at that point. And that's where our spring VCT would kick in and start to make its investments. Some of those will be follow-on investments from the Ventures EIS. So those companies that do really well, we'd follow on our investment into those and make sure we're not diluted away in terms of our shareholding. But yeah, at that point, companies have kind of gone through that valley of death, and we can be very hopeful that they'll go on to be big institutional companies and have some next round funding at Series A or Series B, where things start to get really, really serious. So that hopefully gives you a bit of an idea of how a company starts and how it scales and grows and where we're investing. Risks and relief. I talked about risks and relief at the very start, and I flicked past, as most people do, the compliance slide. Actually, do you know what? I'm going to go back to it because I think this makes some actually really good points that we can run through. So here's our SCA key risks. As I say, normally I'd go past this slide quite quickly, but actually, let's go through them one by one. So first of all, the FCA tell us you can lose all the money you invest. So if the business fails, you lose 100% of your money. Absolutely right. EIS, VCT investments are in early stage companies. They can and do fail. FCA makes the point that most startup businesses fail. I'll counter that, and I'll come back to that in a second or two. But yeah, absolutely, capital at risk, and 100% of it is at risk. Second one there, you're not going to be protected if something goes wrong. So yeah, there's no FSCS protection with an EIS or VCT investment. So that's qualified that one. Number 3, you won't get your money back quickly. Again, yeah, as we say here, even if the business is successful, it's going to take 3, 5, probably 5, 7 years to get money back to you. There's also no secondary market. So if it's an EIS investment, for example, there's no way you can sell your shares and get some money back. A VCT will have probably a buyback option. So you can buy back shares, normally at a discount, kind of 5, 10% of NAV. So you can get your money back, but at a discount. So again, there's not an easy or particularly quick way to get your money back. It is fairly illiquid. Point 4 is about don't put your all eggs in one basket. So that's the whole diversification piece. Again, I'll come back to that in a bit more depth later on. And then the last one is the value of your investment could be reduced. So again, yeah, we're investing at an early stage. You'll be issued shares. If more investors come in along the way, which they're very likely to do, you'll be diluted away. And there'll be different rounds of shares and have different rights, and that could dilute you even further. But as I always say, you're much better off having 1% of a £1 billion company than 10% of a £1 million company. So even though you dilute it away, if the company grows and grows and grows, which is very much what we're aiming for with an EIS and VCT investment, then you still should see some really significant returns. Just to go through on the risks, and there's a couple I didn't cover off, or the SCA don't cover off, so I just wanted to go through there to make sure we've got a full set of risks here. First one will be around liquidity. Again, we talked about it a second or so in the life cycle, but EIS will be reliant on a small number of customers, and a VCT, again, won't have many more customers, but any decrease in downturn in sales, as we saw during COVID, maybe, for example, is going to have quite a big effect, or much bigger effect on a small company than it would a larger company. Other point to make there, years and years ago, we used to have what we call lower risk or capital preservation EISs. Obviously, with the patient capital review, they've gone. Everything in EIS and VCT world these days is focused on growth, technology, and innovation. They're the kind of 3 keywords in this sector now. Product-wise, obviously, yeah, again, we talked about it in the life cycle a little bit, but new companies might not be able to bring their product to market, or might not, or take longer than they think to bring their product to market, or the income streams that they generate might not be as much as their pitch deck told us in the first place. All of these things are risks. There's lots of things that can go wrong along the way, but there are ways of mitigating risks, as we'll see in a minute. Volatility we talked about. I think we talked about exit risk in terms of liquidity and getting money back to clients as well. So we talked about that one. The only one there would be tax risk. So obviously for an EIS and VCT, they need to be qualifying. The company needs to be qualifying not just at the investment stage, but all the way through that investment. So 3 years for an EIS and 5 years for a VCT. In terms of risk mitigation, I think this is a really important one. That we very much sold the case in the last couple of slides that VCT and EIS investments are risky, but the Enterprise Research Council here found that, yes, while companies that don't receive a VC funding Only 45% of them survive beyond 3 years. Those that do receive funding, so those companies that we're investing in through EIS or our VCT portfolio, only 13% have died. So this really tells you just how important VCs are to a small company when they're investing. We're not just handing these companies money and saying, look, let us know how you're getting on in 3 or 5 years' time. We're going on that journey with them. We're working with them hand in glove. We have KPIs that they have to work towards. We give them a venture partner who sits on their board and make sure they're reaching the ambitions that we want them to reach. As I say, it really is a marriage. We're going on this journey with the companies that we invest into. And so whilst funding is important, actually our VC experience is also important at the same time. Also, another couple of studies that were done recently, two important ones here. So one was the syndicate room study. They looked at around about 150 VC investments. They found the probability of an overall capital loss within 5 years is only about 5%, which is probably, as it says there, about the same as an equity market. So you can build up a portfolio of EIS investments pretty quickly. An EIS fund invests in around 8 to 10 companies. If you're doing 4 to 5 EISs, already you're up to kind of 40, 50 companies. If it's a VCT and you're doing 4 or 5 VCTs tend to invest in more companies, so maybe 15 to 20, maybe 25. Again, 4 or 5 VCTs will get you up to 100 company investments pretty quickly. So it's quite easy to get up to that 150 capital investments quite quickly, and that spreads obviously your risk. Second report was done by Harman & Co. They're specialists in the VC market. They did a report that the outcome was that venture capital can improve returns by 0.5% to 1% per annum without changing the portfolio risk for investors with normal risk appetite. So obviously with compound interest as well, what we're starting to see is that these can really push the gains up. So if we consider there, we said 0.5, between 0.5% and 1%. So if we can take 0.7%, for example, per annum on a lump sum for 20 years, that will add 15% to our total value. So it can really add a lot of additional return for a client, as it says there, without changing the portfolio risk. Potential clients, I think it's important to understand what clients these type of investments might be suitable for. So just to run down the list here. So obvious one maybe is company directors. So company directors are obviously really lucky. They're able to choose how they take their remuneration, whether it's salary, whether it's dividends, or it's pension contributions. They can take as they wish. The important thing for them is that obviously for a VCT that's paying out a dividend, the VCT is tax-free. So they can take that dividend, dividend, not pay any tax on it. They can take dividends from the business and therefore offset the two. So that can be a good planning option for them. And obviously, many of them will be high earners, so they'll be able to use the income tax release from EIS and VCT and reduce their income tax liability. Landlords, buy-to-lets, high net worths. So high net worths and high earners probably see above for company directors, but certainly for landlords and buy-to-lets, if they're selling a second property, if they made some capital gains on there, EIS is perfect for them. They can defer those gains. I say it doesn't kill the gain, unfortunately, but it does defer it. And you can keep deferring. So you can keep making EIS investments, and obviously you can take that to the full extreme, and then that CGT deferral will die on death. So as I say, it doesn't extinguish, but it can defer the gain, which can be a really good tax planning point to take to clients. Similarly, any clients selling assets subject to CGT or IHT, obviously the CGT exemptions are changing. And at the end of this tax year, they'll be just £3,000 from memory. So if you're rebalancing portfolios or for etc., beware that could trigger a CGT gain if you've got a client with a very large portfolio. But again, you can use an EIS or to defer the CGT. And then the other one will be on bond encashment. Obviously, people have been in bonds for a long time. They're probably pregnant with gains. Again, EIS VCT planning can really help out some of those pregnant gains. Pension contributions, obviously seen pension contributions go down and down and down over the years. Again, EIS VCT can be a good alternative, or better still, a good complement to pension contributions. They will obviously accumulate wealth, so they help people or clients accumulate wealth as we go along. And again, obviously we've got the income tax considerations there. And then finally, there's a bit of a catch-all in terms of any general suitable clients or anyone seeking diversification. Again, we'll talk about diversification in a second or two. Suitability-wise, the usual standard supply, I guess, really, they need to have the understanding and experience. Capacity for loss is really the key one for me here. They need to have capacity for loss, because as we looked at with the FCA risks earlier on, there is a capacity for loss that is quite high. attitude to risk, personal liquidity, and a balanced portfolio of other investments. And the last point I'll make here is one, again, going back to the HMRC Kantar study that was made earlier on. Within that study, HMRC identified 3 key groups of investors when they spoke to investors that they kind of bunched together. So I thought it'd be a good insight to tell you who those investors were. So the first group was what HMRC called savvy investors. So these were high net worths, experienced investors. They had lots of spare capital to invest. They made relatively large amounts into EIS and VCT. And while they're motivated by the tax release, actually, they kind of saw EIS and VCT investment almost like a hobby or something to tell their mates down the pub. And they were excited to see the outcomes of some of the investments that they made. They almost go on the journey with some of those companies. So that was a savvy investor group that HMRC identified. Second one was what they called passionate investors. So again, these were similar to savvy investors, high net worths, perhaps not quite sophisticated investment-wise, but their real motivation was more about their interests and the areas they were passionate about. So it might have been the environment, it might have been healthcare technology, or it might just be a particular idea or product that they're really interested in and believe in. But they invest with a very specific focus. And then the last one was what HMRC called moderate investors. So this is a group that weren't high net worth, they weren't particularly experienced. They're just looking for a tax advantage place to invest their cash, having used all their allowances elsewhere. So they tended to invest smaller amounts, and their central motivation probably was the income tax relief, as we saw earlier. But you can probably see, you can probably think of in your own client banks or go away and have a think about it, but you can probably identify different savvy investors or passionate investors or moderate investors within your own client bank. So well worth taking some time to think that through. Diversification, touched it a couple of times, so let's fire into it and see what we've got here. So you'll probably recognize this. This is 50,000 simulated portfolios, and you'll see going left to right, what we're looking for here is the good old efficient frontier. If we can find that line somewhere down the middle there, that's our optimum asset allocation and optimum return against volatility. So we've simulated 50,000 of those. You can see the red dot here and the yellow dot. Is it yellow or orange? Anyway, orange we'll call it. The red dot and the orange dot here are the most important ones. So the yellow marker there that we're looking at is our kind of classic portfolio, our 35-55 split between bonds and equities, bit of cash thrown in for good luck as well. Probably what most clients have in their portfolios. That kicks out a return of around 5.69%. Volatility is 8.67%. But as you can see, it's below our efficient frontier. It's not the optimum asset allocation that we could do. If we move up to our red marker there, or sorry, our orange marker there, what we can see here is we're adding a little bit of infrastructure. So that might be a business relief investment. Adding a little bit of small cap, that might be an AIM investment. And more importantly, we're adding a bit of venture capital, 10%. And then we're obviously adjusting our equity and bonds accordingly. So what we see is the return is pumped up to 5.98% without too much increase in volatility at the same time. It comes out at 8.94. So if we flick back, we can see we've moved very much closer towards the efficient frontier here with that yellow or orange marker there. So that's much more of an optimum asset allocation there. And that really goes back to kind of against traditional thinking. So traditional thinking is that VCTs, EIS might be the next best tax advantage investment cab off the rank, if you like. But actually what we're seeing here is that what the evidence we're really seeing here is that this approach doesn't result in the best client outcomes. What we should be doing, having VCT, EIS, pensions, GI investments, it should be complementary to each other and done at the same time. So we're not suggesting replacing venture capital with, we're not suggesting replacing pensions with venture capital or anything like that. Only that the two should be done in tandem at the same time and be complementary to each other and built up in parallel. That is the best or the most optimum asset allocation. We've moved towards our efficient frontier. So in summary, by introducing VC, we can push up the efficient frontier. We can improve the return, as we saw earlier, by about 0.5 to 1% per annum. And we can do all of that by improving the risk-adjusted return without increasing the risk. Quick look at an EIS portfolio. So this is one of around kind of 10 investments. So general standard EIS, you can imagine. So what we're seeing here is how it all plays out over the course of that investment. So generally, 3 companies will fail, they'll lose their value. The important point to make here is that we can use loss relief at this point. So that's going to be a really important one for those companies that fail. And of course, they'll fail earlier than ones do really well. So it's important to have client expectations set at that point to say, look, as I say, the lemons are ripe before the plums. You need to give some bad news before you give the good news later on. 4 companies there will return a kind of around 3 times the money invested, so that's not a bad outcome. We're fairly happy with that. But more importantly, 2 companies return 7, and then there's our big outlier, our company that's going to return 24 times the money invested. So that's the company that's going to drive the returns. That's going to wipe out the losses we made earlier on. So that's why our diversification approach is so important within our EIS portfolio. For VCT, just multiply these numbers by 3, really. A VCT portfolio would normally hold around 20 to 30 companies. Diversification, as Steph Klarmer here says, that it's not about how many different things you own, it's about how different the things you do own are in the risks they entail. So this is the important one about uncorrelated assets and just really playing on what we talked about earlier in terms of adding in different elements to your kind of normal 60-40 mix of equity and bonds. That's where VC can really play a part. Okay, so looking ahead to this year, obviously 2023 has been almost a nightmare year. We've had wars, we've had energy crises, we've had interest rate rises, we've had inflation, you name it, we've had it. And 2024, quite frankly, hasn't started much better in terms of kind of world economic news. But there is a good outlook for SMEs. And of course, this year we will have an election at some point. We don't know when, but we're supposed to have an election this year. And actually, this year, I believe from memory, is going to be the year more voters go to the polls than ever. So 64 countries have elections this year. So the world at the end of 2024 is going to look very different to how it looked at the start of 2024. But the outlook for SMEs is really good, and it's really good for these 5 key reasons. So first one's over to the left there, valuations are easing back. What we saw in 2023 was startup valuations really reached some crazy heights in the last year or so. We're seeing kind of 30 times multiples, 25 times multiples. It really rocked back now. There's been a bit of a shift. A lot of the tech valuations we're seeing are a much more reasonable kind of 8 to 10 times in recent months. That means for us, there's a much lower entry point. There's a lot more headroom for growth. That's really good for us. It's really good for you as investors, particularly, hopefully, as the economy starts to grow, there'll be a lot more room for growth. Digital solutions for big problems. Again, we know the economic situation is pretty dire at the moment, but it doesn't impact what's happening at the macro level. Those trends are still going to be there. We still know that digital transformation is progressing rapidly, but there's many legacy industries, businesses who still need to be transformed by the capabilities of technology. So the world's facing huge problems. Technology is going to be the best solution to tackle those problems. So it might be sustainable energy networks. It might be cutting edge healthcare. It might be delivering more or better, more equitable financial services, as we know in our world. Clever entrepreneurs are out there. They have digital solutions. They will solve their problems, and that will lead to world-leading companies, which is going to be great for some of our portfolios. Downturns always accelerate in innovation. So we've seen this, that history tells us an economic downturn is generally a period of rich creativity and innovation. Entrepreneurs are forced to focus on world problems, real world problems, and there's an urgent need to solve them in a capital efficient manner. So we've seen in the past that half of the Fortune 500 were creating a downturn. That includes GE, so Thomas Edison, of course, 1876. That was in the middle of a world recession. Microsoft was founded in 1975, while the US was submerged in stagflation. LinkedIn in 2002 on the back of the dot-com bubble, and then Airbnb in 2008 out of the liquidity crisis. So there's no reason why this downturn shouldn't be any different, and there'll be some world-class companies coming through in the next few years. Number 4 there, founders are more capital efficient. So look, a downturn tends to mean investors have a better advantage because we can instill more resilience in founding teams and force them to become capital efficient. So capital efficiency is already driving up valuations. We're starting to see the fact that entrepreneurs appreciate the value of cash much, much more. Many of the companies we work with are focused on cash flow at the moment. Cash flow is king for a company, of course. So they're cutting back, they're making changes, they're very much focused on cash at the moment. That seems to be what most companies are focused on at this moment in time. So what we're really getting back to is trying to see some healthy fundamentals for some of these companies. We've seen over the last few years, it's kind of been this Silicon Valley growth at all costs mentality. That's really moving away now as most recession-proof individuals try and look towards healthy cash flows instead. So they're much more capital efficient. I'll touch on number 5 already, but just say venture capital and their businesses. So the best and the most experienced VCs have weathered previous downturns. We know how to work with these companies. We know how to spot them and to nurture them, to work with them and give entrepreneurs the hands-on support they need, not just that funding, so they can grow sustainably. We can present opportunities to them, and we can build a clear path to profit. That's very much what we're focused on. So look, anyone looking to invest in VC in the next year or so, the ingredients there are all there really to support and try and create great companies. There's low valuations, there's more capital efficient environment, highly resilient and determined entrepreneurs, and there's great relationships with founders and their teams. Those, we think, who take advantage now will have an outsized impact when the economy, hopefully at some point, roars back into life. Just adding on to that, let's look at some hot sectors for 2024. So probably no surprise that as we drive towards, no pun intended, as we drive towards trying to move over to EV vehicles, that electric mobility is right top of the list there in terms of how much is being raised in particular sectors at the moment. Closely followed by EV battery, again, C number 1. If we need more electric cars, we need more EV batteries. So that makes sense. And that's high on the investment landscape as well. Autonomous mobility, this is self-driving vehicles or wheelchairs or kind of any kind of vehicle really. Again, seeing lots of investment at the moment. Circular economy, so that's kind of renewables, waste, that kind of area. Again, we know we have a problem. We know we have COP26 obligations, etc., etc. So not surprised to see a lot of money going into that sector. Challenger banks, we're seeing more and more of them. I know Monzo are doing a huge raise at the moment. We talked about Atom Bank and Starling Bank earlier on. Space tech really coming to the fore. There's a new space race going on at the moment. A lot of private companies get into that sector. Think of Elon Musk, for example. Blue economy is the ocean, so ocean waste, how we improve our oceans, and what's happening there. And then just going down the list, cybersecurity has been big for a long time. The big one that looks quite small and probably shouldn't be is generative AI. So AI really cuts across all of these different sectors. AI is the hottest thing out there at the moment. We see around 2,000 pitch decks a year. Probably 90% of those have some kind of AI offering within them. So whilst AI itself isn't high up on the investment there, it is really cutting across all of these different sectors, and it's obviously going to be huge over the next few years or so. Just an important point to make here about company revenue growth itself. So this is a graph taken from Wealth Club, looking at all the VCTs in the market at the moment, but actually not just looking at their NAV growth or the share price, looking underneath the bonnet a little bit and at the companies that sells within those portfolios. And what they're focusing on here is revenue growth. So the red graph is showing us revenue decline, the white one is showing modest revenue growth, and the important one is the green one because that's showing us high revenue growth. And you can see there, out of all the VCTs in the market, Blackfinch is doing particularly well. 85% of our companies are experiencing high growth. So we're investing in companies that have headroom for growth. They will kick out dividends at the same time. We'll talk about that in a second or two. But as you can see there, we're growing. We're not just investing in established companies with established revenues. We're investing in companies with growing revenues, and that's really important to growing their NAV over the next few years. And then just to finish off with just a bit of a plug for our Blackfinch EIS portfolio and our VCT. So on the EIS side, we're targeting a kind of 3 times return. We are growth investors. We're pretty agnostic in terms of where I'm investing. We tend to be looking at tech-enabled or tech-focused companies. That's our real forte. All of our founders are tech entrepreneurs. They have grown and built businesses, so they know this sector really well, and they know how to find the companies to invest into. So that's really important. Establishment fees 3%, AMC is 2%, and the important thing here, that's capped at 4 years. So we're only going to charge an AMC for 4 years. After that, we get nothing in terms of an AMC. So we're incentivized to try and exit some of these companies. So no fees after those 4 years from an AMC point of view. We have one of the highest performance hurdles in the market, so 20% at over 130% hurdle. That's really important as well. We're looking at kind of 4 to 7 years. And the next important one is probably the bottom line there. There is an option to be fully invested by 5th of April 2024. So if you invest by 15th of March with us, you'll be fully invested. The important thing there is, or 2 important things. One, you can carry back and do carry back investments to the previous tax year. That's really important because you need to be fully invested to do that. And also, you'll get your EIS certificates in probably around June time, depending on HMRC, but probably getting them back in 3 or 4 months, which is super quick in terms of getting EIS certificates back. And of course, you need an EIS certificate, an EIS certificate to be able to claim the income tax relief. So that's why that's so important. And then the big news in our Blackfinch Spring VCT is that we are paying a dividend. So congratulations to us. We're not targeting anymore. We are actually paying out a dividend, and we can announce that today. So if you invest by 3rd of April, you will be allotted by the tax year end, and that will qualify you for a 2.5 immediate dividend. We will then pay another 2.5 dividend later in the year. So please do take advantage of that. We still have a couple of early bird offers as well on the charges. As I say, the important thing is 3rd of April, get your money into us by then. We can then allot you by the end of the year, and that will immediately give you access to that 2.5p dividend. Just other points to note there as well. Again, on performance hurdle, that's one of the highest in the market at 20% above £1.30 and the high watermark. And the VCT, as I said earlier, very much follows on from investments from the EIS. So all the strong, really performing well investments in the EIS will follow on the VCT, and we'll find some new ones to go alongside those as well. But let's say the big news there is on the dividends. So there we go, back to the start. I've taken us up to 2:41, so just inside our 45 minutes. Fantastic. So just going back on our learning objectives. So we have described the venture capital landscape. We've looked at how that's working at the moment, what's happening in the world of VCT and EIS. We've looked at how it supports entrepreneurs, the economy and investors. We talked about the tax reliefs and how they work and how they operate and what they are. And we looked at some client scenarios, particularly in terms of those savvy and passionate investors, and looking through your client book to see if you can find any of those. And then the last one we looked at was the risks. So we looked at the FCA risks, we looked at some other risks, and more importantly, we looked at how to mitigate some of those risks. And the big one there is around diversification. That Hardman study, that 0.5% to 1% per annum return without increasing the risk, is a really important one if you're adding in to an overall portfolio. And of course, we looked at 5 kind of key takeaways or points you can make to clients. So hopefully you can talk to clients now confidently and competently about EIS and VCT investments and what's happening in the year ahead. Looks like we've got one Q&A here. If we're working with power attorneys for an elderly client, what's the IHT planning? Is there any main concern with BR and EIS? Oh, that's a complicated one. So if I might mind Simon, who's given us that question, I'm going to take that one offline and answer that in a lot more depth than I would otherwise be able to do in kind of 2 or 3 minutes. But thank you very much for the question anyway. So that's it. We're done. I say we've gone through our learning objectives there. Thank you very much for joining us this afternoon, and please do enjoy the rest of your day. Thank you.